Hello, and welcome to this episode of Chart School. My name's Tom Luongo. This is the Gold, Ghosts, and Guns channel, and today we're going to talk about Episode 2, The Fractal Nature of Time. And what I mean by that is we're going to discuss the way time interacts with price when analyzing stock charts. And so time and price interact in a fractal way in markets and in analyzing stock charts, and I'm going to show you the way that works today. And I'll give you some examples of that, and I hopefully they'll be useful for you. All right, so let's start with the beginning. That the first thing to remember is that the rules of charting are universal, meaning when you're looking at a chart, it doesn't matter whether you're looking at a 5-second chart or a 1-year chart. You still have, over that particular time frame, you only know open, high, low, and close. You only know those 4 prices: what it opened at, what it closed at, what the high price was, and what the low price was. And it doesn't matter what time frame you're looking at. The rules of what governs a reversal and what governs a consolidation and all of that stuff, those things are universal. And they don't change. And so therefore, you're going to apply those rules in a consistent manner in order to analyze what's happening. Now, what is different about them is the fact that the longer the bar, the more data it aggregates, the more human behavior and human decisions have been aggregated within that bar, and therefore they take on more significance. There's more trades, there's more volume having changed hands. All of those things happen over greater periods of time. Not always, right? But in general, everything about a longer time period will tell you more than about a shorter time period. Not necessarily, you're still going to look at things and note significant aberrant behavior, and that's what you're looking for. You're not looking for normal behavior. You're looking for aberrant behavior, because aberrant behavior is what moves markets. All right, aberrant behavior is an indicator of a change in sentiment, and that's what you're looking for in trying to identify when the current price range or the current price trend is going to reverse or significantly change, because that's where money is made. Okay, and markets tend to want to lull you into a false sense of security. Oh God, this thing's never going to move, and then all of a sudden, boom, it breaks out. And then once it breaks out, it goes really quickly. And why is that? And you can see those impulse moves building in the short time frame, but then you have to always check the longer time frames to see if they're technically significant or not. So from that understanding, that's how breakouts can gather force through time. That a breakout on the 1-hour chart, right, from say a consolidation range, if it moves above a particular price from the previous day, then it would also be a breakout on the daily chart as well. And if that was also bigger than last week's high price, well, then that's a weekly breakout, and that takes on more and more significance, so that short-term signals can become longer-term signals. So I'm going to show you an example of how a breakout from a consolidation range in the gold market led to a 7-month bull market that, in the grander scheme, wound up being not very interesting at all. All right, so I'll show you how that changes, how each of the 3 charts that I'm going to show you, how they tell you different things, even though I'm applying the same rules every time. Okay. But before I do that, I got to kind of back up and go back to episode 1 just to make sure we're all on the same page about what constitutes a reversal and what doesn't. Okay, so right here we've got the gold monthly chart. We've got the monthly chart of gold. So each bar here represents a month's worth of trading. Okay, and what we're looking for here is an example of a change in sentiment and a reversal. And so what we have is this nice long 5-month downtrend, and that 5-month downtrend was precipitated by this bar right here that I've got my mouse over. So, and why is that? Well, because so when reading a candlestick, this is the high price, that's the low price. If it's an up bar, it opened here and it closed here. And if it's a down bar, it opened here and closed here, but the stick is always the range of prices over that period of time. So over the range of this month, from here to here is the low. And you'll note that we closed right about at the low for this month because there's no bottom tail. So what you're looking for in a reversal, so you can assume here that we had an uptrend here in gold. And then this was the low at 1312.80 in what looks like July. But then in August, we closed below that level. And so this constitutes a one-bar reversal in that we closed below the low of the previous bar. And why is that significant? Well, because the high and the low define where the supply of sellers or buyers overcomes the other guys. So when you're at a top, at a high price, that determines that was the price at which the sellers overwhelmed the buyers and were able to drive the price down. And conversely, a low is where the supply of buyers overwhelms the supply of sellers and drives the price higher. And so those mark immediate support and resistance points that the asset has to overcome, and the traders of that asset have to overcome in order to move the price away from that particular price range, right? It's a very important point to understand that this is all about market psychology. And so once you break through and once you close below a certain level, that constitutes a pretty strong signal. I mean, these are not absolute signals. This isn't always 100% of the time is the price going to go lower from here. What you're looking for is something better than a coin flip, because then that's an edge that you can use to start assessing pot odds as to whether or not you're going to be able to make money to the downside or to the upside, depending on the situation. In this case, it's to the downside. So, one bar reversals are very, very strong signals. They're easily 75%. There's easily a 75% probability that the price is going to go lower from there, even if it's only minimally. And since everything trades differently, the amount of money that's on the table or whatever, that all depends on the thing that you're trading, and its internal volatility and its historical trading patterns and everything else. Okay, so. But that's not germane to this discussion for the day. That's actually should be episode 3 of Chart School. So we have a reversal here, and that reversal turns into a massive downtrend. We drop down from the 1300s to all the way down to the low 1100s, to the low of around 1120 over the course of 5 months, from August, September, October, November, boom, December. All right. Now, note here that we also have an example of a one-bar bullish reversal. So this was a bearish reversal. This is a bullish reversal. Why? Because here's the high at 1186.70, and we opened here. We didn't approach this low. We didn't violate that low. We violated this to the upside, and then we closed above it in January at 1208.60, and that set things going for the rest of the quarter. And then there was this nice 4-month uptrend, which then eventually died. It was a little noisy, but it got there. And we moved from, so if you had bought, a weekly close here above 1186.70, around say 1190 or so, you could have sold at around, $1,300 or $1,280 and made $80 in the gold market. And if that's in the futures market, that would be significant money. And if you had bought a gold stock that has 2 or 3 times leverage to the gold price, you could have made yourself a nice 25-30% trade. Okay, so that's the way that works, and in both directions, down and up, by shorting the stock up here and going long here. Okay, and using these basic reversals ideas is very important. Okay, all right. So now let's look at identifying breakouts, because this is another. And now we're going to get into the fractal nature of time portion of the presentation. I wanted to remind you about reversals. Now I'm going to teach you about consolidation. So here we have a nice big long downtrend. We got a one-bar reversal here, right? Closed above the low here, above the high here. That's a reversal. But notice that wasn't strong enough, even though it was an engulfing bar and all this other. I mean, I can go on. I can talk about this bar for 5 minutes. I'm not going to. But just note that it wasn't strong enough to to go higher than this high, which would be the next point of resistance on the chart, right? So you bested this high. So now you got to best this high. And if you don't, what happens? And then so we got a reversal, but then we kind of traded around within the range of this next bar for the next 3 weeks. This is a weekly chart. So we're starting here with the weekly chart. So this is what we got. So nice long 6-week downtrend, reversal, consolidation. So this is all now consolidation. Note that after 3 weeks of playing around within the range of this bar, we get an impulse higher, and we break above this high from back here, but we don't close above that high. Very important. As a matter of fact, we opened here, went all the way up to here, and then closed way down here. This was a very, very, I remember this week. It was ugly. Okay. And, because, I follow the gold market like it's, like it's my daughter's development, for Christ's sake. It's kind of crazy, but that's my own problem, not yours. So, but I remember this week, and I remember being despondent about the price collapse. And then the very next week, we got a breakout, and the price reversed itself again. Now this isn't considered a reversal because there's no trend here. So this is just a consolidation a breakout of consolidation from range. We closed above this high. We finally bested this point of resistance. It's kind of a weak signal. I would have preferred it to have closed above both this high and this high from the previous week, but sometimes you take what you get, because it was good enough to then set things in motion. I would have bought here, and if I had been trading the gold market at this time, I would have bought here with the idea that my stop would be set first at the low of this bar, then the low of this bar, and I would just keep moving my sell stop up each time as to where the reversal signal would be. It would always be the next, low, because then that low would define where the reversal is. So let's now move out to the monthly chart. Let's see what happens. So now we start looking at the monthly chart. Notice that this was the end of this whole slide here is really just like these bars right here, these 3 bars right here. But notice how this was a big long downtrend in the gold market on a monthly basis. So all of 2015 was this grinding, awful bear market. All right. But notice how that impulse here in early January to push higher turned into a reversal signal on the monthly chart. It had enough impulse that it was able to push high enough to not only break out from consolidation, 6-week consolidation between these 2 bars here, but then to turn that into a 1-bar reversal on the monthly chart. And that sparked a massive rally in gold. So if you had bought here at around 1100 off the bottom of 1045, which by the way might wind up being the low of the entire gold bull market right here. Okay. Or bear market, I'm sorry, the low of the entire 6-year gold bear market. And this impulse right here could be the beginning of a very weak bull market, which is taking 2 years now to gather enough steam to push higher, and I'll show you why in just a second. But that's the beginning of the turn, and we've never approached this price again. And this signal was that strong that we pushed us far enough away that we never approached that price again, and we got this nice big uptrend all the way through the Brexit vote in June, and then it pushed higher in July, and then after that, then we got a reversal here in August. Okay, and that's when this part of the bull market ended. And now I'm going to show you why it ended. It ended because look at all of these. This is now the quarterly chart aggregating 3 months worth of trading, and notice how we've never gotten a close anywhere close to this area between 1360 and 1390. It's just a maze. 1355 and 1390 is just a maze of resistance where sellers came in at the quarterly level and said, no, gold is way too expensive here, and they were able to push the price lower. And so this is these 2 bars right here. We got to push up to 1375 here, and then the price collapsed. In Q4 of 2016, Donald Trump was elected. The dollar broke out and went on a tear for a couple of months, and the price of gold collapsed. But notice that it did not approach the low from 2015, going all the way back to that weekly chart I showed you here. Okay, so this low is now very significant. This area right here is incredibly significant. And by the way, this is the price range you're looking at for a quarterly close above this level is your signal that the gold bull market has the new gold bull market has begun. And I fully expect to see that in 2018 as an aside. So, because we've done the work here. Now we've got 5 quarterly tops. And it still hasn't been, once we break through that, it's going to be a massive signal to the upside. And then gold will probably explode from there and immediately move back towards its all-time high. Okay, so weekly little consolidation from range, breakout, reversal, resistance. Potential low for the entire bear market right here. This is the 2015 low. 2016 is very interesting, but in 2017 is more consolidation if you look at it from a yearly perspective, which I don't have a chart for. Okay, so that's pretty much what I have. If you like what you heard, great. You can subscribe to the channel. I'd really appreciate it. Also, give a like. And you can follow my work over at goldgoatsandguns.com. And if you really like what you see here and you think that I have a handle on how to invest in these markets, then you can go over and give me some support over at my Patreon page, which is patreon.com/goldgoatsandguns. For $4, you get the private blog of trading tips and chart analysis like this of particular things that happen in the crypto and gold and commodity space. And then there's, for $12 a month, there's also the investment newsletter, which will give you a model portfolio and a portfolio strategy for dealing with what I think is going to be one of the most tumultuous periods in human history. All right, you guys take care. You have a great day, and we'll talk soon. Keep your stick on the ice.